Most people think banks are afraid of you carrying debt. They imagine some executive in a glass tower nervously watching balances climb, hoping customers pay everything off before things get risky. But the reality is far more interesting. Banks don't panic when you carry a balance. In many cases, they quietly celebrate, not because they want you bankrupt, not because they want you to fail, but because a carried balance, stable, consistent, revolving, is one of the most profitable events in modern finance. Picture this. It's the end of the month. You open your credit card app. The number is higher than you'd like. Not catastrophic, just uncomfortable. You scroll down and see the minimum payment, $138. You could pay the full $3,400 balance. It would sting, but you could. Instead, you think, I'll just pay more next month. So you pay $200, maybe even just the minimum. You close the app, relief. That small decision, that rollover, is not dramatic in your life. But inside the banking system, it activates a machine built on math, behavior, and compounding. Here's what most people never see. There are two types of credit card customers in the industry's internal language: transactors and revolvers. Transactors use the card, collect points, and pay the full balance every month. They generate revenue through merchant swipe fees, small percentages paid by businesses every time a card is used. Helpful revenue, predictable but limited. Revolvers, on the other hand, carry balances from month to month. They pay interest. They generate high-margin recurring income. If you were designing a financial institution optimized for profit, which customer would you prefer? The one who uses your product for free? Or the one who pays 19%, 22%, sometimes 26% annually and does so consistently? The uncomfortable truth is this: the most profitable customer is not reckless. It's not someone who defaults. Defaults are messy. Collections cost money. Bankruptcy erases balances. The most profitable customer is stable, but slightly stretched. Someone who makes minimum payments on time. Someone who revolves. Let's slow this down and look at the numbers. Imagine two people. The first spends $2,000 a month and pays it off in full every cycle. The second spends $2,000 a month but carries a $6,000 balance at 22% APR. The first customer might generate a few $100s a year in interchange fees. The second might generate over $1,300 a year in interest alone. Multiply that by millions of cardholders. You start to understand why carrying a balance isn't treated like a crisis inside the system. It's treated like a revenue stream. And here's where the architecture gets subtle. Minimum payments are not random. They're engineered. They're low enough to feel manageable, high enough to avoid default, but rarely high enough to aggressively reduce principal. At 22% APR, interest accrues daily, not monthly, not annually, daily. Every day your balance sits there, interest attaches itself quietly, invisibly. If your balance is $8,000, that interest might be costing you several dollars every single day. You don't feel it, you don't see it, but mathematically it's constant. And the system knows something about human psychology. People anchor to minimums. If the minimum says $140, your brain interprets that as acceptable. It doesn't scream urgency. It doesn't demand structural change. It suggests maintenance, and maintenance is profitable. Now consider promotional 0% offers. Zero interest for 18 months. It feels generous, almost supportive. But the deeper logic isn't generosity, it's conversion. Banks understand that when the psychological barrier of interest disappears, spending resistance drops. Balances grow faster during promotional periods. And statistically, a meaningful percentage of customers will not pay off the full amount before the rate resets. When it does reset, often above 20%, that accumulated balance becomes interest-bearing. The bank didn't lose 18 months of profit. They planted a future one. The same logic applies when your credit limit increases. You've been carrying a balance responsibly. You've been paying on time. You get an email. Congratulations, your credit limit has increased from $10,000 to $15,000. It feels like trust. It feels like financial progress. But from a risk model perspective, you've proven something very valuable. You revolve and you pay. You're predictable, and predictability is gold in finance. A higher credit limit increases potential interest revenue. It also lowers your utilization ratio, which can boost your credit score, which encourages you to use the card with more confidence. It feels like empowerment, but mathematically it expands capacity. Now zoom out. In the broader economic picture, interest is a transfer mechanism. When households carry balances at high APRs, money flows steadily from consumers to financial institutions. Not dramatically, not in one painful moment, but gradually, predictably, year after year. Higher income households are statistically more likely to pay off balances in full. Lower income households are more likely to revolve. That means interest payments disproportionately flow upward. The system doesn't need to be malicious to produce this result. It just needs to be structured around incentives, and it is. Credit cards are not evil. They are tools, but tools generate outcomes based on how they're used. When you carry a balance, the math works against you. When you pay in full, the math works for you. The bank still earns interchange fees when you transact, but the high-margin revenue, the compounding revenue, disappears. You shift from revenue engine to low-yield customer. Banks don't hate that, but they don't design marketing around encouraging it either. You'll see endless ads about rewards, travel points, cashback, sign-up bonuses. You rarely see aggressive campaigns that say, "Pay everything off immediately and never pay us interest." Because the system is optimized around behavior, not morality. No one is forcing you into debt. But the incentives are carefully arranged. Minimums that soothe, promotions that delay pain, limit increases that expand capacity, rewards that encourage swiping, all subtle nudges. And here's the deeper layer. Banks operate on statistical models. They don't need every customer to carry a balance. They just need enough. A relatively small percentage of heavy revolvers generate a disproportionate share of profits. That concentration is powerful. It means even if many customers pay in full, the model still thrives. So what does this mean for you? It means carrying a balance is not neutral. It's not just, "I'll deal with it later." It's entering a compounding agreement, an agreement where the daily interest clock never stops. The moment you understand this, your behavior shifts. You stop asking, what's my minimum? You start asking, how fast can I eliminate principal? You stop seeing available credit as extra income. You start seeing it as rented purchasing power. And rented money, when expensive, erodes wealth quietly. The irony is this: the people who understand compounding best are banks. They use it daily. They rely on it. They design around it. When compounding works for you through investing, it builds wealth. When compounding works against you through high-interest revolving debt, it builds theirs. The system doesn't run on emotion. It runs on math, and math is indifferent. So why do banks love when you carry a balance? Because it creates recurring, predictable, high-margin revenue. Because it rarely defaults when minimums are met. Because it compounds quietly. Because it scales across millions of accounts. But once you understand the mechanics, you gain leverage. You don't need to fear credit. You need to respect its structure. Use it for rewards. Use it for convenience. Use it strategically, but refuse to let it compound against you. Because the difference between someone who revolves for 15 years and someone who pays in full for 15 years isn't just interest, it's wealth trajectory. One builds net worth, the other funds financial institutions, and that's the real story behind a simple minimum payment. This isn't about blame, it's about awareness. Once you see the architecture, you can't unsee it. And once you understand the incentives, you stop being shaped by them unconsciously. You start choosing deliberately. That's the shift. That's the strategy. And that's how you move from being a revenue source to being the one who understands the system. This is Money Science AR, and when you understand the mechanics, the power dynamic changes.